The stock market is bipolar. Bipolar disorder is when you have mood swings from being depressively low to being maniac high. We see this all the time. Sentiment within the stock market is either going up in a maniac fashion or is depressing and it's highly down for many years. And it goes up and goes down, goes up and goes down. So, market fluctuations is the key theme of this video. 7-year maturity of high grade intermediate bonds would potentially protect you from market crashes by not greatly depressing the value. So having some portion of your investment in this potentially makes sense. Common stocks can go down 50% within a year or less. So even really great companies like Berkshire Hathaway, you can see their stock patterns twice so far. They have seen the top value of the stock price to the bottom change 50% in less than a year. So if you can't stomach that, at the minimum 33% drawdown in your stock portfolio, then you're probably not qualified to be an aggressive investor or a stock picker. If you give emphasis to the market timing, again, you are getting into this speculator area. Those people who give forecasts, there is no mathematical basis for this based on Benjamin Graham's 100 years of looking at the data to prove convincingly that those forecasts have more than a 50% chance of being right. Even big economists, like what we looked at in the last video, including the Federal Reserve chairman, had a hard time predicting the economy. So pay very little emphasis to market timing. Both timing and pricing needs to be factored in for your buy to be a bargain buy. So look what you're getting into as a stock picker. You need to get really good at timing and pricing. I say timing primarily because if you buy at the time when the bipolar nature of the stock market hits you in the opposite direction, unless you are financially very much stable and psychologically very much stable, you will either lose a lot of money or you will feel left out. So both timing and pricing, you don't want to pay a full price for the future value of the company either. So you have to be, in a way, lucky for both of these factors to work out your way. Any smart investment formula, there's so many. People say invest in dividend stocks, invest in growth stocks, invest in value stocks, invest just in December when everyone's selling because of tax reason. Hundreds of such formulas you will see people come up with. None of those smart formulas that has ever worked in the past will certainly not work in the future because of two main reasons. Number one is every day is a new day. There are new market situations that formula may not be adapted with. New people come into the market. There are new behavior, customer trends, everything changes. Similarly, also, let's say everything is the same, but if everyone finds out because this formula is really good and it's popular, then it becomes commonplace. Everyone knows this, so you can't really beat anyone. So huge fluctuations in market need to have the psychological and the analysis part very strong to be able to get in the right set of stocks. A bull market typically has the characteristics of a high price to earning. Prices are really high across the board and overall stock market as well. The dividends the companies are paying much lower compared to the corporate bonds. Dividends, margins, and leverage is being used excessively, and speculative behavior with everyone talking about stock markets at the coffee table or at the water cooler. Any break time, everyone's talking about stock market. That's when you know that it is highly speculative and bull phase. Also, when you see a lot of poor quality IPOs that are not even profitable, we covered this in the last two videos. It's another major sign. But there is no clear sign, and there is no real way to say, hey, the bull market will run for 6 years, 8 years, because there are times in which it ran for 12 years, 1949 to 1961, 10 years, 1990 2000, the current one, 2008, 2019 plus, 11 plus years. So it's hard to predict how many years. But the longer the bull market runs, the more severely investors will have amnesia. They'll forget that there is ever a possibility of a bear market. After about 5 years, many people lose the thought that there's potentially a bear market. And all those who forget the past are doomed to be reminded. And in stock markets, recovered memories are always unpleasant. So it's very important to study what you're getting into. Rebalancing is probably the only thing, and sticking to your 50-50 or your 75-25 or your 25-75, whatever that rebalancing asset allocation you have in mind. And that the satisfaction and having that satisfaction of you not using your pent up energies of doing something in your mind, trying to detect patterns, just the satisfaction of doing contrary to what the market is doing. If everyone's buying, you're selling because your asset allocation says it's time to sell. That's probably the best you can do to deal with bull market and bear market scenarios. A good business stock is not the one that you have bought for not just a good asset value price that you have bought it for, but also it needs to have good earnings potential in the future. Past history of the earnings should be stable, good financial position to weather any storm of a bear market, and have a good moat and a leadership team and manpower to get through in the future, get through any issues of the future. So that's a characteristics of a good quality business. But remember, great businesses also have a great deal of speculation built into it because everyone wants to buy that great stock. But also, stock markets, as being bipolar, you will find opportunities where the entire business can be bought at a much, much lower price, at a depressed price. So you got to be careful as to when you get in if you're picking stocks. What if you could not see the market for the next 30 days? This is an interesting challenge. That's a good way to factor out a good business from a bad business if you want to see if you're buying in the right business. What if you couldn't see that stock ticker for 365 days, a whole year? Would you still buy that company? That's a good way to see if you're buying into a good business from an intuitive gut feel perspective. And that did happen actually in the history. There were certain periods of months or years, I don't know exactly, where there was no stock price available. And when it restarted, it started at the new price. So make an effort to see if you can not look at the stock market. A true investor scarcely ever is forced to sell his shares. This paragraph is probably the best paragraph in the last 10 chapters that I've read in the book. So I've taken it as is from Benjamin Graham's book. A true investor scarcely ever is forced to sell his shares, and at all other times he's free to disregard the current price quotations. What does this mean? The market every day, every second will give you a price quotation. The true investor is never forced. No one comes and tells you, you gotta sell, you gotta sell, you gotta sell. You have full control. He need pay attention to it and act upon it only to the extent that it suits his books. If you find out that you need to rebalance because of certain percentage over your threshold, then that's when you pay attention to it. Then you look at how all of your portfolio is doing. If you think it's too high of a price that you had thought of, the interest rates has a huge impact on the economy, credit rating of the company has changed, overall market situation, then you'd probably look into it. But no more. Thus, the investor who permits himself to be stampeded or unduly worried by unjustified market declines in his holdings is perversely transforming his basic advantage of control, full control. As a mutual fund, you don't have control. You gotta sell when everyone tells you they want to sell. But as an individual investor, you have full control. And that's your basic advantage. But if you don't remember that, you make it into your basic disadvantage. That man would be better off is in his stocks and had no market quotations at all, for he would then be spared the mental anguish caused him by other person's mistakes of judgment. Everyone who's participating in this bipolar market is facing some level of bipolarness within themselves. So you could have a huge um, time saving if you were to focus on maybe studying the annual reports, how the results are, how operating results of the company are doing, instead of looking at the market. So in summary, if you have the money to invest regularly, then spreading it out, investing regularly with the caution of stomaching at least 50% drawdown, then you should invest regularly. There's no doubt in an index fund, most likely for most of the users. Shareholder value is most important as well. So the management or the leadership team doesn't understand this fact, then it's very hard for those companies to sustain good investors over a long period of time. Remember, even if you are doing your own investment, you are analyzing how they're doing over time. Similarly, the leadership team should understand that the shareholders are investors, so you owe them long-term returns, average returns, consistent returns over time. You cannot beat large number of traders and financial analysts at their own games. If you're trading, if you're speculating, they're much bigger, faster, 100% dedicated speculators out there. It's very hard for you to beat them. Interest rates have a huge impact on liquidity and bond prices, which in turn has a huge impact on stock prices. So doing a deeper study here would be a beneficial endeavor. Bond prices are even harder to predict compared to the stock prices, and currency prices even harder than bonds. So this is a big area, but the complexity increases in this way. Stocks, bonds are even harder, currency is even harder. Nothing important on Wall Street can be counted on to occur exactly in the same way as it happened before, as we talked about the two principles. As it becomes more popular, everyone finds out there is no advantage that you have. And the second one was what worked in the past will not work because everything is changing every day. New equations need to be built every day. New conditions are happening every day. The challenge to do is see if you can not look at the stock market for 30 days. And if you can do that, extend that to 60 days or the 90-day period or when your rebalancing period happens. Avoid this pattern-seeking behavior that we all have come up with since the time we had to fight for our livelihood from carnivorous animals. We have a lot of pent-up energy as well to act, to do something, to trade, to make some decisions. This is where you have the most control. Our job, in summary, is to control our bills, how much we can save on the expenses that we make. That is the biggest factor on can you save more than what you spend. Then that's probably a big factor that we can control. Taxes. There are ways in which you could, if let's say your assets are depressed in a certain index fund is depressed, and you want to buy it maybe let's say 30 days from now, you do have the advantage of tax benefits. There are certain laws that you have to go through. So you could, let's say, sell in November and maybe there's a 31-day or a 60-day, I don't know exactly. You can buy back if the assets don't appreciate, but also then you could factor in losses that you could get benefit into your tax write-offs. So there are many strategies here for taxes. Risk is something that you can allocate and manage with asset allocation. Expectation is another big area that you can control. Remember, you need long time in the market to make money. Ownership and brokerage costs are another big area that you can control by choosing wisely. And the most important, your behavior, your pattern-seeking behavior, the impact of the bipolar stock market on us, the impact of daily price fluctuations, all of that has an impact and changes our behavior, especially when we see people around us making decisions, coming up with new innovative formulas. We also have this pent-up energy that comes up. So that is the behavior change, the psychological change, the maturity that we need to assure ourselves regularly that we're not going to play that game. We've learned through reading this book that we are going to stay disciplined and control what we can control and just keep investing. Thanks. Hope you liked it.